Hello, everyone. I hope everyone's having a pretty good day so far. I think we're going to jump right into it for another version of our year-end tax update and some planning strategies that you can consider. A couple of housekeeping items before we move on. We will have a polling question for those of you looking for CPE. That'll happen about midway through the presentation, and we'll give an announcement when that polling question is coming up. Post-presentation, we will send out the recording and the slides, so those will be your way eventually. And if you have any questions, please put them in the chat feature and we will get to them at the end of the presentation. But we'll answer questions at the end. And then we'll also open up questions at the end if there's any other questions that people may have as we go through things. Here's our contact information if you need to get a hold of either of us or if you have any questions about what we'll be talking about today. A little bit of a lengthy agenda, but here are the topics we're hoping to cover. We want to talk about the Tax Cuts and Jobs Act and the potential sunset that could happen 1/1 of 2026 and what that's going to mean for the different tax provisions that are out there. We're going to talk about some of the tax plans proposed by Trump and what that could mean. We're going to get into planning for individual tax items throughout the different year. We're going to talk about retirement accounts in the SECURE 2.0 Act and a couple of ideas there. We're going to touch base on green energy credits. We spent quite a bit of time on this last year. Much more truncated version this year, some of the highlights of things to consider. Going into business taxation, there have been a few Nebraska updates we want to touch upon. Then lastly, some planning opportunities and then question and answer. So that's our agenda for this afternoon. So with the sunsets, so we had a pretty major tax legislation, January 1st of 2018, the Tax Cuts and Jobs Act. Variety of different tax cuts, variety of different tax provisions. A lot of those are set to expire at the end of 2025. So starting 1/1/2026, we're basically going back to the old rules that we had in 2017, which for a lot of taxpayers means higher tax increases and less beneficial tax provisions. Some of the things we wanted to highlight is if you look at the rates too, pretty much everyone's tax rate will be going up if this comes into effect 1/1 of 2026. It's going to hit pretty much every single type of taxpayer. We're going to be in a situation where the AMT, the alternative minimum tax, could come back into play for several different taxpayers, particularly if you itemize your deductions. There's a chance that that could come back. And why you would be itemizing your deduction is if you take a look at our standard deduction amounts are going to be cut in half. It's less than 10% of people that currently do the itemized deduction approach. But if the standard deduction gets cut basically in half, it's going to be applicable to much more taxpayers. And the personal exemption would also be coming back. So that's another twist that we haven't had to worry about for a little bit, but there is that $4,000 personal exemption that would be returning. Child tax credit goes back down to $1,000. We had this concept of a credit for other dependents. One of those children for $500, that will go away. Our charitable deduction contribution limitation would go back to 50% of adjusted gross income compared to 60%. And the positive change for those who itemize your deductions is we have this $10,000 limitation on your deduction for state taxes for your itemized taxes. That would possibly disappear. And what that means is for the different states that have this pass-through entity tax regime, where you try to have the business pay the taxes as opposed to the business owners, a lot of those regimes might no longer be in play as we go back to the old rules, where now the individual, it doesn't really make a difference. They'll be paying the taxes for the business compared to the business to get this deduction, because you're still going to get that deduction if that SALT limitation is removed. Mortgage interest deduction, more preferential, goes back to that $1 million threshold. Miscellaneous itemized deductions, we've been in a period of time now where any of our miscellaneous deductions that were subject to a 2% of AGI limitation would be returning. Most notably of those would be investment fees. So on any of your investment accounts, we couldn't deduct those investment fees. Those would be coming back as a potential deduction. So for businesses, key things to keep in mind here, the qualified business income deduction, that 20%, that would disappear, which would be a pretty big hit for anyone who's conducting their business through a pass-through entity, such as a partnership, LLC, or S corporation. Bonus depreciation would continue to phase out, and then we'd hit 0% for bonus depreciation in 2027. Qualified opportunity zones are pretty much done with to begin with, but those would just be no longer allowed completely going forward. As you can see a trend here, for the itemized deductions, there were a lot of limitations on those, but a lot of those limitations are being removed. So any unreimbursed employee expenses would now be reinstated. Those are one of your 2% miscellaneous itemized deductions. That would be back, which would be a benefit, positive benefit for certain employees. And then meals provided for employees would be disallowed as a deduction. Note on the estate tax exemption, you have a lifetime of exemption of about 13.6 million this year, just under 14 million for next year. That would also be reduced. And that would be about, if you do the calculation, 7.5, starting 1/1 of 2026. So we're losing at about 6.5 million or more of exemption. Annual exclusions don't go away. You still get that $18,000 per year or 19,000 starting in 2025, but the lifetime exemption basically gets cut in half. That's a pretty big change if that's to go through. So we're highly recommending think about any type of estate planning to use up that exemption before 2026 rolls around, because it's pretty much use it or lose it. If you use it now, there's no negative effects going into 2026. But if you don't use it now, well, it's just basically lost, and you're not going to be in a good position going forward. Before getting into the Trump tax plans, I do want to say a word on the whole Tax Cuts and Jobs Act sunset to begin with. All this is set to happen by operation of law starting 1/1/26. But Trump himself has said that he wants to extend a lot of the Tax Cuts and Jobs Act legislation. So everything we're talking about might not actually go away, but we're really not going to know for sure until probably the winter time of 2025. So all we can do is recommend this is what's going to happen by law. It can change. Maybe some of this stuff gets reinstated. The other thing I want to note is in order to reinstate some of these provisions for the Tax Cuts and Jobs Act, it would probably be done through this whole budget reconciliation process again. And in order to do that, there's a trade-off with how they have to do some of the financing and budgeting for it. To reinstate the entire Tax Cuts and Jobs Act would be very expensive. Honestly, probably not that feasible. So if anything, there's only going to be probably only portions of it that are going to be reinstated and not the entire thing. We really won't know until probably the fall or winter, because from what I'm understanding, talking to a few people on Capitol Hill, there's other priorities from the incoming Trump administration, more so on just budgeting, border security, tariffs, so on and so forth. Tax legislation isn't a huge priority. Something probably will happen. Some of these provisions probably will be reinstated, but it won't be the full thing, and we really won't know which ones until probably later on next year. Dovetailing off of that, if you look at the election and how that shook out, it's a narrow majority as well in Congress to try and get any type of tax legislation passed. It's probably going to be a little bit more difficult. And like I said, with the Tax Cuts and Jobs Act, how expensive it is, it's probably just going to be certain portions of it and not the entire thing. And how Congress currently looks only lends more credence to the idea that something probably will happen next year. It's just going to be more narrow as to the actual effect. Now, looking around from what Trump has said for various different tax proposals out there, I can't find anything concrete per se, but here are a few things that he has mentioned during some of his rallies or that he has put out there. Here are the things that he would like to see for any type of tax reform. Right now, our corporate income tax rate is 21%. That would be reduced to 20%, and then that could be reduced even further to potentially 15% if companies actually make their products here in the United States. There would be a new tax deduction for the quote unquote major costs with newborn babies. I know Vance himself has talked about increasing the child tax credit to potentially $5,000 for younger children. There would be possibly a tax deduction for interest on car loans. Then multiple times he said he'd like to exempt these types of income from taxation. So Social Security benefits, tip income, overtime pay, or income from Americans working abroad. The big proposal, though, is to make permanent the Tax Cuts and Jobs Act. So all the things I talked about at the beginning that are expiring, the hope would be at least keep these around for another 5 years or so. go back to the better tax brackets, keep the higher child tax credit, really keep the 20% qualified business income deduction. The one change though would be that $10,000 limitation on state and local taxes for your itemized deduction, that would probably change. That'd either be at a much higher threshold or just completely disappear where any amount can be deducted and not just the 10,000. That would be the one change to the Tax Cuts and Jobs Act that you probably could see, but doing that would be fairly expensive. So more to come. Likewise with the estate tax, from what I'm hearing there is the hope would be that that would probably just be frozen at $14 million with no future inflation adjustments. So we wouldn't drop down to that 7.5 million starting in 26. It would just be basically frozen at $14 million per person going forward into the future. Then some other positive business provisions that we'd like to see come back is 100% bonus depreciation, 100% expensing for research and developmental expenses. Right now, you would have to amortize those costs, and an EBITDA-based interest limitation, which would be for your 163J business interest expense. This would be allow more businesses to deduct more of their business interest expense. Right now, we can't really factor in depreciation and amortization, which has impacted quite a few businesses that are highly leveraged. In order to pay for a lot of these proposals, a lot of the clean energy industries and green energy tax credits are going to be revisited. The big thing you're probably going to see is anything for electric vehicles will probably disappear. But a lot of these other green energy credits for industries will probably stick around in their current form. We just won't see any big expansions of them going forward. His other proposal is new tariffs. So baseline tariff, 10 to 20%, 60% tariff on China, 100% tariff on goods from countries that break with the US dollar for trade. And the thought would be possibly some personal income taxes could be offset with these increased tariffs. More to come there. Right now, it's just been a lot of proposals with a lot of substance about how this would actually work in practice.
Next, we are going to go into individual tax updates and provisions. Starting with the 2024 individual rates. So as Dan had mentioned earlier, with the expiration of the Tax Cuts and Jobs Act, in 2026, if there is no changes, the bucket tax rates will go up. So you won't have the same 7% that you see on this slide, but for 2024 and 2025, they are still the same 10, 12, 22%, and so on. So you can see on this slide, there's single on the left, married filing jointly on the right. And then this next slide shows 2025 individual rates, and the amounts are indexed for inflation each year. So 2025 amounts increased from 2024 and 2024 increased from 2023. Then the last rates we have are capital gain for 2024 for single, married filing joint, and separately, and head of household. And these rates are preferential as compared to ordinary income tax rates. As you can see, they're 0, 15, and 20%, which are also indexed for inflation.
I'm going to jump in here a little bit to talk about casualty losses and some of the hurricanes we've had down south. Just some touch points here. We haven't really had to see casualty losses come up all that often, but I do want to mention it in case you were impacted. Because circling back again to this Tax Cuts and Jobs Act, they had some changes about how you can actually claim casualty losses as an itemized deduction. It's much more strict rules, and that's the same rules that would apply for 2024. So in order to even take a casualty loss, you need to check online to make sure you're a federally declared disaster area. If you're not in one of these disaster areas, you're not allowed to take a casualty loss at all. And this would be for a personal casualty loss. Something happens to your home, something happens to your vehicle, something happens to your other personal property. You're subject to a $100 per casualty limitation and a 10% of your adjusted gross income limitation as well. So there will be a haircut on this personal casualty loss that you're trying to claim. You use Form 4684 to actually make the claim for the casualty loss. Like I mentioned, you need to go online to actually find if you're in these disaster areas, and there's a special number per disaster you need to include on that form in order to get this loss. The key limitation for this is these are losses not covered by insurance. If insurance covers your loss, you're not allowed to claim a casualty loss. This is only for the losses not covered by insurance or in excess of what insurance did cover. And your casualty loss is a lesser of your decrease in your fair market value or your adjusted basis of the property pre-casualties. The standard of proof isn't that strict here. All you really need to keep for your records is the cost of the repairs incurred to replace the property. This is all about personal losses. Business casualty losses have different rules. And typically the business casualty losses are a lot more permissible than the personal casualty losses. The personal casualty losses are a little bit more strict, but if you're trying to claim one of those losses, that prior slide has the highlights of what you need to consider. So the two main hurricanes, Milton and Helen, also talking about tax deadlines. So any deadline after October 5th of 2024, any tax filing deadline has been pushed to May 1 of 2025. If any of the states offered a qualified disaster relief payment, you don't have to bring that into your taxable income. And keep in mind, if need be, there are special provisions for your individual retirement account, your IRAs, where you can make a special distribution out of your IRA in order to cover certain disasters, if you're part of one of these disaster areas. I'm going to touch on cryptocurrency as well. If you've been keeping track of the news, you've seen that Bitcoin has been hovering right around $100,000 here. And a lot of the other crypto tokens have been doing fairly well as well. Just as a reminder, there was supposed to be a report for cryptocurrencies similar to brokerage statements when you have your stocks and bonds, this form 1099-DA. That hasn't happened yet. It's supposed to start 1/1 to 2025, but there's nothing for 2024. So it's still really on you to keep track of your basis of these assets and try and figure out your proceeds, which is a very time-consuming process. In case it's relevant for anyone, if you're receiving cryptocurrency in your business operations, it's treated somewhat similar to cash, where you have to do this special form 8300 if you're actually getting paid in cryptocurrency in your business. So it's a little twist out there because you would think, well, that form only applies to cash, but it does currently cover cryptocurrency as well. And that's not a fun surprise if you miss that. Only other development in cryptocurrency for this year I want to mention is there's this new revenue procedure out there. It's a little lengthy. It can get a little technical at points, but really what it's trying to get at is if you hold your cryptocurrency in multiple different wallets, you don't have to treat all those tokens as just being from one monolithic wallet. You can break it out on a wallet by wallet basis. And what that allows you to do is more beneficial specific identification of your different tokens you're selling. So similar to stocks, you can pick which cryptocurrency assets you are selling. So you can probably pick your higher basis assets first compared to your lower basis assets and get a better tax result on the sale of the cryptocurrency, as opposed to having to do the first in, first out method, which the IRS has been saying for a while now. But if you can prove you have separate wallets and you can prove when you bought these different tokens, you can get a better tax answer. And the IRS has blessed this by saying you can do it on the wallet by wallet basis, and you can pick which crypto tokens are being sold if you can prove that you bought it on a certain date, which most reporters from the different crypto brokerages, Coinbase, etc., you can get the reports there that you need to get a better tax answer.
Next, we will talk about Form 1099-K, which is used to report payments you may receive for goods or services during the year. And historically, the threshold for filing Form 1099-K is if you have more than 200 transactions totaling more than $20,000. But with the American Rescue Plan Act of 2021, this threshold was decreased to $600, which is a significant jump. So this kind of made taxpayers a little afraid or weary, thinking that they were going to receive many more 1099-Ks than they usually receive. But in 2023, they actually delayed using this new $600 threshold and used the old rules. And then for 2024, the planned threshold is going to be $5,000, which is kind of a phase-in to implement the $600 threshold in the future. And Congress has said money received through third-party payment networks from friends and relatives as personal gifts or reimbursements for personal expenses are not taxable. So, for example, I think for Venmo, you might now have the option to, when you're paying someone, check a box, whether it's for you're paying someone personally or for some type of business, service or good. But even with that being said, these thresholds will probably bring a lot of new activity to light, such as vacation homes, Airbnbs, side hustles, and whatnot. And the IRS is targeting Schedule C, E, and F filers. Here we have the standard deductions for 2024. As Dan mentioned, only about 10% of taxpayers actually itemize. That's because the standard deduction has increased so significantly for inflation, and since there's no longer personal exemptions. So for 24, it is $27,700 for married filing joint and $14,600 for single. And you can get an extra bit of standard deduction if you are over 65 years old or blind. And the state and local tax deduction is still limited to $10,000, but states came up with a way to avoid this $10,000 limit through PTET. And as you can see on the right, the picture shows that a majority of states have enacted PTET legislation. And that brings about the question if the state and local tax $10,000 threshold goes away, will PTET go away as well? And that all depends on a state-by-state basis. So some states have no end date for PTET. Nebraska is one of these states that, thankfully, if the $10,000 threshold goes away, Nebraska will still have PTET. But other states around Nebraska, such as Colorado and Iowa, their PTET will expire if the $10,000 limit expires.
And if it expires for some of these surrounding states, that's something to keep in mind, because now the business isn't going to be paying the tax. It's going to be back to you as a business owner. So you have to budget and think more about, oh, okay, at my individual level, I need to make sure I have this cash in hand to pay the tax, just like the old days, as opposed to running it through the business. But that will not apply to Nebraska. Based on how the Nebraska legislation works, it's probably going to make sense to keep doing the pass-through entity tax at the business level for Nebraska, even if there's some other changes to the SALT limitation, and even if the Tax Cuts and Jobs Act gets extended.
That's a good point. And I know we have a list out there of all the states and whether or not PTET will expire. So if you're curious and if you do business in many states, you can just reach out to your accountant at Lutz, and they should be able to tell you which states PTET will expire for. The mortgage interest expense limit is still $750,000 for 2024. There is no deduction for home equity loans, but debt that was acquired or refinanced before 2017 is grandfathered in and can use the $1 million threshold limit that was before the TCJA was in place. Charitable contribution limits are still at 60% of AGI. And for a tax planning consideration, we tell taxpayers they may want to consider bunching their charitable donations every other year. This will help them itemize since standard deductions are significantly higher. And one way to do this is through a donor advised fund, which Dan will talk about in a few slides. There's also qualified charitable distributions from retirement accounts, as well as considering donating stock if it, has appreciated in value and you don't want to have to, recognize the gain on your tax return. You can choose to donate that stock. Then medical expenses are still limited to 7.5% of AGI. Alimony entered into after 2019 is not deductible and not taxable to the receiver. And then the child tax credit is still limited to $2,000 for now. And the income thresholds are $400,000 if you're married, $200,000 if you're single or head of household.
So quick note on the donor advised funds. I was pretty excited last year when we got some regulations about donor advised funds that have been 17 years long in coming. We haven't heard anything more on that. I thought there was going to be a lot more flurry of legislation about donor advised funds. The IRS doesn't necessarily like them because, as Leslie mentioned, it's somewhat of a way to get around your itemized deduction limitation thresholds. Because what you can basically do, and I'm sure this is familiar to a lot of you here, is you take your contribution that you would otherwise give, you give a large contribution in 1 year to an entity, and different brokerage accounts have donor advised funds you can use of theirs or your local community foundation. They set up an account, you get a deduction for your big gift into the account, but then over the next number of years, that account can make your quote unquote normal distributions out to charities over a period of time. So you can put $50,000 in, and say $10,000 over the next 5 years can flow out to your charitable beneficiaries. You get that $50,000 deduction in year 1, even though the charities aren't going to get their money until the next 5 years. IRS started to come out with some regulations last year, mostly definitional updates. The big issue with the regulations was that your investment advisor couldn't be both your personal investment advisor for your personal assets and your donor advised fund. IRS has gotten some pushback on that. But we haven't really heard anything more about donor advised funds, and it's been well over a year now. It was 17 years before we even got to this stage. For the time being, donor advised funds are still a great option. And that's all there is to say at that for now. So, annual and estate gift limits. We mentioned at the beginning how the lifetime exemption before you're subject to estate tax is at different thresholds. So I would have to gift away over 13.6 million this year or 13.99 next year. And it is inflation adjusted too. So even if you gift the full 13.61 this year, you'll still get that extra 300,000 that you can use next year. Our state tax rate is still 40%. That's not going to change. What has changed is our gifting exception, because there's that exclusion each year that doesn't eat into your exemption and doesn't subject you to gift tax. That's $18,000 per person this year, and then jumps up to $19,000 next year. 2 key ideas I want to mention that don't use either your annual exclusion or your lifetime exemption. If you do a direct payment to someone to some higher education, like a college or university for a beneficiary, that doesn't count. Or if you're paying medical expense directly to a hospital, that doesn't count. So those are 2 other ways to get around some of these limits. And I like throwing this chart up there because it shows you what's going to happen. Because if you look where we're at right now, 2024, look where we're going in 2025. If we don't get any type of tax legislation next year, we fall down quite a bit. And that exemption would just be lost if you're not using it. So if you haven't thought about your estate and you're in a situation where you have a fair number of assets, you really should be talking to your attorney. Because the other estate planners that I know, it's going to take some time to actually get these plans in place. So your best time to start talking about them is this winter or next spring, just in case. Because if nothing happens, you'll lose out on a pretty big exemption. The IRS has said that they're not going to claw back anyone who would, quote unquote, overuse their exemption. But if you don't use it, you're not going to have it going forward. That means you could be subject to tax on, say, $7 million at 40% that you could have avoided otherwise if you were just planning ahead of time.
So next, we will go into the Secure 2.0 Act, which was passed in December 2022, and it makes numerous changes to retirement plans that are beneficial to individuals. The provisions have various effective dates, and we're just going to go over some of the key changes that you may want to be aware of. Starting with student loan assistance and educational expense assistance. Starting in 2024, individuals can roll over up to $35,000 from a 529 plan into a Roth IRA. 529 plans are investment accounts for educational expenses, but let's say if someone had this savings account and they decided they didn't want to go to college, they could roll it over into a Roth IRA. And the 529 plan must have been opened for more than 15 years. Employers can now offer qualified educational assistance programs as a tax-free benefit of up to $5,250, but this provision does expire after 2025. And then finally, employers can make matching contributions to retirement plans based on qualified student loan payment amounts, which are any debt incurred by an employee to pay qualified higher education.
And for any employees out there, I do want to mention that it says employers may. So your employer actually has to put that in their plan first. These aren't benefits that you have out there that you might have been missing. Your employer needs to effectively change their plan before these benefits are out there. But the employers have this option that they can.
Yep, exactly. So next we have auto enrollment and auto escalation. The Act requires certain employer plans to automatically enroll employees, but they have to be allowed to opt out of the plan within a certain amount of time. And auto enrollment plans have to require the plan to automatically increase the participant's elective deferral each year. So that's where the auto escalation comes into play, but it's also something that employees have to be allowed to opt out of. And then for QCDs, this amount is now indexed for inflation. So rather than being $100,000 every year, it is now $105,000 starting in 2024. And individuals can use up to $50,000 of their QCDs as a one-time distribution to a charitable gift annuity or charitable remainder trust.
Quick note on that point, because while you can do these 50,000 QCDs into a charitable gift annuity or charitable remainder trust, economically, it might not actually make sense to do so with some of the administrative costs of actually running those going forward. So just because you can do it, I would think very seriously before actually doing that. Still, the QCD itself directly to a charity, great idea. The gift annuities or the charitable remainder trust, I would exercise some caution there.
Participants in retirement plans, such as a 401k or an IRA, are required to take RMDs from the plan after a certain age, but that age has now been raised to, or from age 72 in 22 to age 73 in 2023, and then the age will be raised again to age 75 in 2033. Also, Roth accounts under employer plans no longer will be subject to the RMD rules. This change puts employer Roth accounts on par with Roth IRAs with respect to RMDs, because prior to this act, employees had to transfer their Roth accounts from the employer-sponsored plan to the Roth IRA to avoid needing to take RMDs. And then also the excise tax penalty for failing to take an RMD has been reduced from 50 to 25%. And if it's corrected within a specified time frame, the penalty decreases even more. Employees aged 50 and older are allowed to make catch-up contributions to their 401k plan, which is $7,500 in 2024. But the Act allows employees aged 60 to 63 to make increased catch-up contribution equal to the greater of $10,000 or 50% more than the regular catch-up contribution amount. And then additional IRA catch-up contributions will now be indexed for inflation, whereas they used to just be $1,000 every year. And I won't go too much into detail about these special withdrawal provisions, but just know that they're there, and these are circumstances where you can make a special withdrawal without facing the 10% penalty. And they are for personal emergency, domestic abuse, terminal illness, and then I believe.
Quick note on these again, because similar to those student loan payment options, your plan needs to be allowed to do some of this stuff first. So just don't think, oh, you can go out and take some of these distributions. Double check with your plan, because a plan needs to be updated for these provisions. These are more mays than must. So be careful before you actually do it. Double check with your plan sponsor.
Okay. And then the next three are for federally declared disasters, which Dan discussed a little bit, payments for long-term care insurance, and then qualified birth and adoption distribution rules. Next, we will go into the green energy credits. And as Dan had said, It's likely that Trump will try and get rid of some of these credits, whether it's the vehicle credits or possibly the investment tax credit and production tax credit. But for 2024, they are all still available. So we just want you to be aware that these are out there. There are two different types of residential energy credits that individuals can claim on their 1040 return. The first one is the energy efficient home improvement credit, and it is equal to 30% of the cost of energy efficient improvements and property expenditures. The dollar limit is $1,200 per taxpayer per year, but there are additional limits included. And then you can get an extra $2,000 credit for things like heat pumps, water heaters, air conditioners, and so on. So you can see in the yellow highlight that your annual credit could be as high as $6,400 if you're married filing joint.
Quick side comment on this too. I'm not quite sure why, but I have seen the IRS actually send out some audits on these residential credits and asking for proof that you did incur some of these expenses. So if you are thinking about doing this, I would just keep your documentation. It kind of caught me off guard how much the IRS seems to be looking in this particular area to make sure it was valid property.
And that kind of goes along with this next slide at the bottom. You can see that after 2024, identification numbers are going to be required. So let's say you purchase, a water heater or a heat pump, that you will get an identification number that you have to put on your return. So that's a way for the IRS to, verify that you actually purchased it. But here we just break out what exactly energy efficient improvements are versus energy efficiency property expenditures. Next, we have the residential clean energy credit, which is a credit for alternative energy products that rely on renewable energy sources. The credit is also equal to 30% of qualifying expenses. And you can see the list here that it's for things like solar water heaters, fuel cell, small wind, geothermal, battery storage. And the most common one that I've seen for our clients at least is solar panels. So individuals purchasing solar panels for their home would qualify for this credit. And this next slide just shows that solar panels, which are so popular, you get the credit not just for the panels themselves, but also for other aspects such as the PV cells, contract labor, permitting fees, inspection costs, as well as the equipment, storage batteries, and even sales taxes. So like I said, it's not just the panels themselves, it's everything that kind of comes into play to getting these panels up and running qualify for that 30% credit. And this slide shows the difference between the two credits. They have a lot of similarities, such as they are both only allowed on newly purchased property. They're both limited to your tax liability. They have no AGI limit, which makes them very beneficial. So whether you have really high income, low income, you can still claim this credit no matter what. I won't go through the entire list, but you can just kind of see the breakout here, and it'll just be a nice chart to have for reference if you're considering buying something with green energy. Next, we will go into the vehicle energy credits, which, as we've mentioned multiple times, may be cut with some of Trump's changes, but for now, they are still in play. There are three different vehicle credits. The first one is the new clean vehicle credits available to individuals and businesses, non-refundable and no carryover. And all of these credits are pretty hard to obtain, which may be why, Trump is trying to cut them with his plan. From what I've seen, not a lot of individuals qualify for these credits. And you can see here in the yellow highlight, it's because there is the MSRP limit, which is the vehicle you purchase has to be less than $55,000 if it's a car or $80,000 if it's a van, SUV, or pickup. And then there's also the AGI limit, which, if you are single and your AGI is over $150,000, you automatically don't get the credit. So very difficult to get. I haven't really seen it at all. Anyone that I can think of.
I think it's worth noting that I don't know if we've seen a situation where anyone at the personal level has been able to get the clean vehicle credit, but I do think we've seen it quite a few times for the commercial clean vehicle credit, which you're going to get into.
That is true, yes. Here we have the definition of a clean vehicle. Original use commences with a taxpayer, acquired for use, not for resale, has to be made by a qualified manufacturer, treated as a motor vehicle, and has a gross vehicle rating of less than 14,000 pounds. And more requirements for the definition is for battery capacity. The vehicle has to meet the critical mineral and battery component requirements, which is how you actually calculate the credits. This next requirement, I'd say, is what makes a lot of vehicles not qualify, is that final assembly has to occur within North America. And then that website can be used to look up vehicles and whether or not they qualify for the credit. And the credit calculation is $3,750 if you meet the critical minerals requirements, and another $3,750 if you meet the battery components. Those 50 and 60% thresholds are just saying that that's the amount of components of the vehicle that has to come from the US or countries with a free trade agreement. And those amounts have actually increased from 2023. So again, making it harder cars to qualify, and they are going to increase again in 2025. So it's probably going to go from 50 and 60% to 60 and 70%. Next, we have used clean vehicle credits. Again, very difficult to obtain. You can see with the highlights, your AGI has to be less than, if you're trying to get the other credit, it's $150,000 and $75,000. And this is, buying used vehicle credits versus new ones. And on this next slide, we'll show, again, the vehicle has to have a sales price of less than $25,000. And the credit is equal to the lesser of $4,000 or 30% of the vehicle's sales price. The last vehicle credit, which is definitely the easiest to claim, is a commercial clean vehicle credit. So for businesses and tax exempt organizations. In order to qualify, the vehicle just has to be subject to depreciation as well as some other rules. And the credit is calculated as the lesser of 15% of the vehicle's basis and the incremental cost, which is the excess of the purchase price of the vehicle over the purchase price of a comparable vehicle that is not a clean vehicle. This credit is limited to $7,500 if the vehicle is less than 14,000 pounds, which a majority of vehicles are under 14,000. But if they happen to be over, then the credit is limited to $40,000. Also, there's no double dipping. So let's say you purchase a vehicle that's, used partly personally, partly for business. You can't claim both the commercial clean vehicle credit and the new clean vehicle credit. But since the commercial credit doesn't have an AGI limit, it's more likely that you'll be able to take that credit. Here we have just a summary that lists out the 3 vehicle credits, as well as, once again, the website that you can use to search for make and models. And the website does show for the vehicles, the amount of credit that you're likely to be able to take on it. Then we have business energy credits. So every business energy credit has a base rating, and you have the opportunity to get a 5-time higher rate if you satisfy one of the following requirements. So for example, if your business purchases, let's say, solar panels, the base amount is 6%. If you satisfy only one of these, then you automatically get 30%, so 5 times higher. The first requirement is only for projects that satisfy, that produce electricity, so solar or geothermal, and they just have to produce a net output of less than 1 megawatt, which is actually really easy to do. So if you're buying, geothermal or solar equipment, it's very likely that you meet this requirement, and you don't even have to worry about the PWA requirements that are listed in bullet point number 2, because you'll see these requirements are pretty hard to meet. And then the third one is if you began construction before January 29th, 2023, you again don't have to worry about the PWA requirements. You automatically get those 5-time higher credit rates. So PWA, from what we've seen, pretty difficult to meet these requirements. We have looked up, the rates can be found at that website, and you look up, the type of activity going on as well as location. So I know we've looked up a few times in Lincoln and Omaha, and the rates are pretty high. So as well as for apprenticeships, for projects in which 4 or more laborers are employed, at least 15% of the hours on the project have to be performed by qualified apprentices. So that can be difficult as well to meet. There are other bonus credit options available that are less common, and those are if the project is in an energy community, or it meets the domestic content requirements, or as well if it's in a low income community, you can get additional bonus credit options in addition to that 5%. And starting in 2023, there are now options to monetize these credits, so to speak. So it's a way to kind of create a market for the credits, and that is through transferability and direct pay. The first option, direct pay, is for non-taxable entities, and they usually wouldn't get a credit because they don't have taxable income or a tax due. But this is a way, say a not-for-profit entity purchases solar panels, they can still get this credit through direct pay, so they're receiving it as a refund. But this option is only available for certain credits. And then transferability is for businesses such as partnerships and S corps that can sell a portion or all of their credit to an unrelated third party for cash. And credits can only be transferred once. It has to be cash. The amount paid is not included in gross income or deductible. And again, limited to certain credits. There is a kind of extensive pre-filing registration process you have to go through if you're wanting to make either a transferability or direct pay election. So you have to do a pre-filing to get a registration number, and that number has to be included when you file the tax return. So the IRS recommends you register the energy product at least 120 days before the due date of the return, because it can take them quite some time to get a registration number out. The election can't be made on amended returns, and not-for-profit entities will file for direct pay on the 990T. So it's possible that certain not-for-profits don't usually even file a return, and they're only filing the 990T to get that direct pay, the refund of the credit.
I do want to say something really quick here on this transferability. You might be thinking to yourself, well, I'm not going to do anything with green energy credits. We're not going to put any solar panels. We're not going to do anything like that. Why should I care about this? This is in its very early stages. So even if you're not selling the credit, you could possibly be a buyer of this credit, and you could buy these credits for, say, 90 cents or 95 cents on the dollar, maybe even less. And that's a way to offset your own tax liability at a discount. So we're in the very early stages of seeing some of these exchanges set up there. So even if you don't do anything with green energy, you might want to think, if you have a high tax bill, well, I might be able to buy some of these credits for cash, and I can pay a lesser tax bill because I'm buying these credits at a discount. So just keep that in mind. Probably more to come in this area, but it is something that is out there if you're looking for interesting ways to reduce down your tax liability. by buying some of these credits on these exchanges, and you can use them to offset your tax liability. Because a lot of the people are doing this transferability, they don't have enough income where they can use the credits themselves. So there are some sizable credits that are hitting the market out there.
Here is a chart of all of the business energy credits available. Again, we won't go into details line by line, but you can see the applicable code and name of each credit, as well as the effective dates, whether or not it has both the wage and apprenticeship requirements, when it sunsets, if applicable, and whether or not it qualifies for direct pay and transferability. And the same chart is on the next slide with just the remainder of the business energy credits. And to wrap up energy credits, we wanted to go into detail a little bit more. Some of the business energy credits that are more common, we tend to see more often. The first one is the energy efficient home credit, which is intended to incentivize developers to make more energy efficient homes. And it's determined by the level of energy efficiency and prevailing wage requirements. So this is an example of a business credit that only has wage requirements and not apprenticeship requirements. And the chart shows that the amount of credit is dependent on whether it's a home builder or multifamily developer, as well as what type of, Energy Star or Zero Energy Ready requirements it meets, as well as prevailing wage. Then we have the energy efficient commercial building deduction, otherwise known as 179D. And this allows for deduction up to a certain amount for building owners or architects, engineering, design firms that contributed to the energy efficient design of the building. And I wanted to point out that this is a deduction, not a credit. And examples of eligible energy efficient property includes interior lighting systems, HVAC, hot water systems, and the building envelope. And I know we have a handful of clients that claim the 179D deduction, and they're usually getting, cost segs or studies done by a third party in order to help them decide how much of the 179D deduction they can actually take. And going back to them getting a study, the reason why they usually get it is because they do need at least a 25% reduction in total annual power and energy costs. So they have to, show that they did have that 25% deduction and how much that they can actually claim. Next, we have the production tax credit and investment tax credit. So this first one is a little less common. It's a per kilowatt hour credit for electricity generated by qualifying technologies that is sold to an unrelated party. So this is for, companies that are producing some type of, electricity or energy, and then they go and sell it. And the credit is up to 1.5 cents times the kilowatt hours electricity produced from that qualified energy resource. And there's also a domestic supply chain option for the credit. The ITC, as I said, is definitely more common, and this is a credit for an investment into renewable energy property. It's a one-time credit. So let's say you're purchasing a large piece of energy equipment, you get up to 30% times the basis of the qualified energy property. And here we have the PTC, just the different types of technology that would qualify for this credit, as well as domestic supply chain. And the next slide shows the investment tax credit, technology, wind, solar, geothermal, all very common, as well as some others. And to wrap up these credits, I just have an example that shows just how easy it is to get the solar credit. So, for example, if your business were to purchase solar panels that cost $100,000, and let's assume they produce a net output of 0.60 megawatts. Since they produce a net output of less than 1 megawatt, you would automatically get the 30% credit, and you again don't have to worry about the PWA requirements or anything else. So you do the basis of the property times 30% to get a $30,000 credit. And that credit does have to reduce the basis of the property. So you are only capitalizing and depreciating $70,000. But there are no threshold requirements to get the base credit for solar panels. So there are other credits that, you might have to meet a certain number or a threshold in order to get the credit. But for solar panels, it's available for any type of equipment which uses solar energy to generate electricity or heat or cool a structure and so on. So you get the base no matter what. And next, I believe we have our polling question. Like we had mentioned before, if you are trying to get CPE, we will give you a few minutes to answer this question, and then we'll come back on and finish the presentation.
All right, we're going to jump into business topics. And if you haven't answered the polling question, now's your chance, because I think we're going to shut it down right now, probably. So I know that was a lot on green energy credits. We thought it was important just to bring it up to you so you're aware. Odds are there's going to be some significant changes to it next year where it's not really going to be worth talking about as much. The vehicle credits are probably going to disappear, but a lot of the business credits and the residential credits probably going to stick around in their current form. They just won't be as extensive going forward. On to the business topics. Handful of things we wanted to talk about today. Circling back to business meals, excess business losses, 163J, research and experimental, bonus depreciation. All those things haven't really changed. We just want to bring it up to make sure that they're in the back of your brain. A couple of new things we wanted to mention though. What is the IRS focusing on? What's going on with this Corporate Transparency Act? Big developments this month. And there's a little bit of a surprise. We have some brand new IRS forms to talk about. So business meals, we have this chart here, goes through the limitations, different type of qualifications. Thought it was helpful. You can take a look at it as to when you have business meals and entertainment expenses, when it applies. For excess business losses, this is something that we had suspended as part of the CARES Act. Continues on. If I have too much of a loss from one business, it basically gets turned into an excess business loss for the current year. I can't use it, but then it does roll into be a net operating loss for the next year. So if I have a business loss over $610,000 for a joint filer or $305,000 for a single filer, that is something to be aware of, because you're not going to be able to use any of that excess loss in the current year. It's going to roll forward to the next year as a net operating loss, which has its own limitations. So it could be a while before you could actually use some of those losses. Each business activity is analyzed separately. You might want to think about aggregating your business activities if that's the case. And for whatever reason, if you haven't amended one of your returns back for these changes, now is probably your time, because you're getting pretty close to the statute of limitation time where you could get anything. Business interest expense limitation, 30% of adjusted taxable income. Hopefully, as part of some of these TCJ modifications, this will get bounced back up and we get a higher limitation, or we could get to add back in depreciation and amortization. But that's not the case right now for 2024. I think it's worth mentioning too, that I don't think you're going to see any retroactive changes to 2024, even if tax legislation gets done. Everything's probably going to be prospectively 2025 and onward. So the rules we're talking about now probably are going to be your rules, not going to change. I wouldn't have any hope for retroactive relief. So these are the rules that we are working with today. Keep in mind that this only applies more for large taxpayers, where I have more than 30 million in average gross receipts for an average of a 3-year period. You have different options to opt out if you're a real property business or you're a farming business. And as I mentioned, we can't add back depreciation and amortization, so that has hit quite a few businesses hard. Hope is that in 2025, that will be an add back that we can do. Research and experimental expenses. I know I've had a lot of people reach out to me on this saying, is any relief going to be possible? We keep hearing about these different tax laws out there saying, well, yes, we're going to bring back in immediate expensing of research and experimental expenses, but nothing has happened. And that's still the situation we're in. We're still in the situation where we have to amortize our research and experimental expenses over a 5-year period for domestic, 15 if I'm foreign. The more people I talk to on Capitol Hill, retroactive relief is pretty much not going to happen. If anything happens, it's going to be 2025 and onward. We're not going to be able to go back and expense some of the things we've had to amortize. It's probably just going to be for expenses in 2025 onward that we can expense. Unfortunate situation. The only silver lining I can give you is that Nebraska has decoupled from the federal tax law here. And starting in 2025, at least for your Nebraska tax return, you can't start to immediately expense your research and experimental expenditures, but you can make an election to amortize it if you want to mirror your federal treatment. That's the best news I can offer you in this situation. And we have a chart here in the slides if you want to take a look. Here lays out your different qualifications for research and experimental amortization compared to when you can take the research and developmental tax credit. QBI deduction limitations, threshold goes higher. If I'm in one of those specified service businesses, or if I'm in a non-specified service business, then I have this W-2 limitation to keep in mind. Big thing I want to mention here is that QBI deduction does sunset in 2025. So we basically have one more year of this 20% deduction, and if nothing happens, it disappears. Hope is it would be brought back in 1/1/26, but if it's not, that's going to be a pretty huge hit to any pass-through business, any S corporation or LLC, because that 20% deduction has been pretty nice. And if it's not coming back, that's definitely something you want to plan for cash flow wise. But for now, still around higher exemption or higher limitations for this year. Depreciation updates. We're still in this period of time where bonus depreciation is phasing down. Gone are the days of 100% expensing. For 2024, for this tax year, we're at 60%. Then the other 40% is just depreciated under our normal rules. Next year, we go to 40%. Then we go to 20%. Then we go to 0%. The hope is that hopefully next year, we'll go back to 100% for 2025 and onward. But who knows? It's an expensive provision to have in there for as one of the refreshers for any of the Tax Cuts and Jobs Act provisions they want to bring back. This could just stick around and keep dwindling down. But I know there's been a lot of pressure to bring it back. Again, I wouldn't be hopeful for any changes to 2024. I think we're going to be stuck with the 60%. At least there's some hope in 2025 we could be at 100%. Which means if you're thinking about doing big purchases next year, you might want to wait until 2025 as opposed to trying to do anything at the end of 2024 because you might get more bang for your buck. But more to come. Vehicle limitations, if you're trying to buy a new vehicle, 179, since we're in this period where we can't do 100% bonus, we can do 100% 179 expensing instead. So it's an alternative. The only issue with that is there are some limitations as to when it applies. You have a $1.2 million limitation as to how much you can actually use of 179 expensing. Then I have an asset purchase limitation of $3,050,000. So if I buy too much in assets, I don't get to use any of this 179 expensing. And I'm still limited on my total amount of 179 expenses of 1.2 million. So hopefully for fair now businesses, this is a good alternative to bonus depreciation. if you're trying to get that 100% yet. But if you're over these thresholds, I would hope and wait to see what happens in 2025 to hope we get back to 100% bonus depreciation. All right, on to some of the newer stuff and more exciting things, in my opinion. IRS targeted campaigns. What's the IRS looking at? What do they say are their target areas for this next filing season? Well, here it is. Corporations with assets over 250 million, partnerships with assets over 10 million, individuals with income over $10 million. These are the three types of taxpayers that they're really trying to focus their efforts on. Like before, the IRS has said they're not trying to increase audits on any taxpayer making over $400,000 a year. Not that they're going to decrease the audits there, they're not going to increase it, but they're really focusing on the bigger taxpayers right now for what they want to audit. The other issue for businesses is they're really drilling down on your cost of goods sold and if you're really inflating your cost of goods sold deduction or not. So I would just keep that in mind. The other big area where the IRS has come out swinging is on business aircraft. If you're using a plane in your business, the IRS has really been hammering hard down on the personal entertainment rules and making sure you're separating out your business versus your personal component. And there's a lot more scrutiny if you're trying to take accelerated depreciation, bonus depreciation on certain of these airplanes used for business purposes. They want to make sure that that business use is real compared to the personal use component. So if you are using an aircraft in your business, I would highly recommend you talk to your tax preparer or your attorney that's involved to make sure you're buttoned down here, because we are seeing a lot more movement in this area than any time in the past. Then if you're a super large corporation, the IRS wants to look into this corporate alternative minimum tax, which really only kicked into place if you had $1 billion in financial statement income. And this is a special 15% tax. If you notice the trend for the IRS, it was all on larger taxpayers. Another thing I think that's worth mentioning in the IRS targeted campaign area is they got a lot of additional funding through certain bills in the last few years. And over time, that has been whittled down. I'm assuming with this upcoming legislation, it's probably going to be even more of a cut to the IRS budget. So I would think that the IRS is still going to be focusing a lot more of its time on the super high net worth taxpayers in their focus areas compared to any more quote unquote normal people for the time being, just with their budget priorities and the constant cuts down from what they were given. The other area that the IRS is targeting is more in the foreign area. So if you're leaving the US and you're expatriating, they're going to take a harder look at that. If you're claiming that foreign earned income exclusion since you're working abroad, harder look at that. If you're claiming the foreign tax credit on your 1040, harder look at that. If you're doing anything with cryptocurrency and you're reporting income from multiple jurisdictions, IRS planning to take a harder look at that. If you own a foreign corporation, harder look at that. Your FBAR form for your foreign bank accounts, making sure that you're filing those completely, harder look at that. And similar to the domestic area, if you're a high income person and you haven't been filing in the United States, that's another area for them. So really, main two trends for IRS areas are high net worth domestic businesses and individuals, and anything going on with foreign activity.
So the good news is with the Corporate Transparency Act that there is no longer a January 1st, 2025 filing deadline, and that was decided last week. A little bit of background information. The CTA was enacted by Congress in January of 2021, which brought about the BOI reporting requirements. And BOI stands for Beneficial Ownership Information Report. So this requires that all legal entities log on to the BOI website and report information about their beneficial owners. And this is aimed towards stopping money laundering. And initially, there was a January 1st, 2025 filing deadline, but the requirements have been halted due to the U.S. District Court in Texas issuing a nationwide injunction on December 3rd, stating that BOI reporting requirements are unconstitutional. So this halts the reporting requirements. However, if this ruling is overturned on appeal, there will likely be a new reporting requirement deadline. It just won't be January 1st of 2025 because that date is obviously less than a month away.
And the current thinking is that we'd probably get at least 30 days if it does get reinstated to actually file some of these reports. So you still might want to consider filing a report if you think it is going to get reinstated, because otherwise it's probably going to be a mad dash to get it filed. But the report itself really isn't that difficult if you've ever had to do one. We just want to bring up that that deadline is no longer there. Currently, it could come back, but there should be enough time to do it if you need to.
So if the reporting requirements do come back, this just shows what you basically have to disclose on the website when you file. It's your business name, address, formation, jurisdiction, EIN, beneficial ownership information, and company applicant information. There are exceptions to filing this report. The most common one would probably be the large operating company exemption. And this says that if your business has 20 or more full-time employees in the US and gross receipts of $5 million or more in the US and a physical office in the US, then you do not have to file this report. A couple of important reminders. If you are not eligible for an exemption, you are required to file. Once again, this is all legal entities. So this would include a disregarded single member LLC. Reports are submitted through the FinCEN's official BOI e-filing website. As Dan said, it is pretty easy to file, but if you are confused about filing or have any concerns, we probably recommend reaching out to your attorney so they could file it for you. And another important reminder is there is no filing fee for filing this BOI requirement. You should be alert to scams. There are, people saying, hey, if you pay us money, we'll file for you. It costs this much to file, pay it here and whatnot. Just as there were scams with the employee retention credit, there are a lot of scams out there right now. So just be aware.
On to other excitement, new IRS filing forms for 2024. Just throwing these out there, probably not going to apply to a whole lot of people, but to those that do apply, it might be a shock to know that you might have to do this. So the first one is particular to partnerships. And if I have a partnership that's getting non-cash property, there's a new form I'm going to have to file to disclose what that non-cash property is. So if I have a partnership distributing out real estate or other type of land and it's coming out to one of the partners, I have to file this new form with my partnership return to say what's going on with this property. If it's cash, I don't have to worry. But if it's non-cash, be aware that there's this new form that's out there that could take a little bit more time to prepare because we need to get a little bit more information about the property involved. The other new form is for the 83B election. For those of you that have had to deal with this in the past, there was never really a set form. You basically made up your own 83B election form and sent it into the IRS. Well, now there is actually an official form you can use instead. So it's this form 15620. Quick reminder on what the 83B election is for. That's if I get some restricted stock, I can make an election to bring it into my taxable income currently, as opposed to when that stock actually vests in my name. You have 30 days after you're granted that stock to make one of these elections to bring it into income currently as opposed to waiting. Now we have an IRS form that allows us to do this. Not quite ready for e-file yet. If you want to use this new form, the standardized form, you can mail it into the IRS. But the hope is going forward for the 83B elections, we won't have to mail these forms in anymore. We can just submit it electronically online and make all of our lives easier. Okay, Nebraska tax law changes. There was actually a number of different Nebraska changes this year that are worth mentioning, and a few things are coming into play for 2025 that you should just be largely aware of in case it can apply to your situation. The first thing, unfortunately, to talk about is, in my opinion, this whole mess with the property tax credit for Nebraska. It's very messy this year. It's a little bit different. I don't think it makes a whole lot of intuitive sense. Basically, as part of the property tax reform Nebraska tried to do this year, we got rid of the property tax credit portion, and there's only going to be the community college credit portion. Because what we could do is when you pay your real estate taxes, we could claim a tax credit on your individual Nebraska income tax return for the property tax credit and then the community college credit portion. Well, for 2024, they got rid of the property tax portion, but for whatever reason, the community college portion is still on there. And 2025, they're both going to be gone. But at least in 2024, you get the community college portion. What that also means is basically that school district portion for the property tax credit portion kind of just disappeared for 2023. So when you pay those credits, you're really not getting any type of benefit for 2024. With this whole mess with this property tax credit going away, Nebraska did say there's going to be some estimated tax relief and factoring in that property tax credit that you would have received, so you won't have to pay as much estimated tax penalties. What I'm trying to get at here is that property tax credit you saw in your Nebraska return going to be much smaller this year, completely disappears in 2025, but we still need those property tax statements to at least get the tiny credit. And what Nebraska has said is that going forward, you're going to see relief on your property tax credit statements directly. You're not going to get it as an income tax credit, but you do lose out for some of your 2023 property tax credits that you paid in 2024. And from what I'm hearing from the Nebraska legislature, that just is what it is. There's no plans to retroactively give relief. So the pass-through entity tax credit, Leslie touched upon this earlier. So this is applicable for my pass-through entities. We started this up in 2023. The one thing we want to mention here is if you're trying to do that retroactive election for years 2018 to 2022, you still have some time. You have until the end of 12/31/2025 to make the retro election for some of those prior years. And when you make that election, you can pick and choose what years to do. So you can do some in 2024, some in 2025. So for example, the big issue we see in this area is cash flow. And if I have enough cash to make that retroactive payment, because I'm making a state tax payment, which allows me to get a federal deduction, but it can be difficult to have the cash on hand to make that retroactive payment to the state. So you can pick and choose just to do, say, years as 2018 and 2019 and 2024, then 2020 to 2022 and 2025. So if you have the cash on hand at the end of this year, you haven't made that retroactive election, I would think about either doing it all this year or doing a portion of it this year, portion of it next year. Because if you don't make that retroactive election by 12/31/2025, it'll just disappear going forward. Some other new Nebraska tax updates, bonus depreciation. Like research and experimental expenses, Nebraska has decoupled from the federal law starting in 2025. Nebraska will allow you to get a 60% bonus depreciation going forward compared to the phase down for federal where it goes from 60% to 40% to 20% to 0%. So Nebraska will at least let you get 60% in that initial year and won't phase down starting in 2025. So that will be a difference from your federal return to your Nebraska return going that direction. Likewise with research and experimental expenses, if we don't get some type of federal relief in 2025, at least Nebraska is saying for your Nebraska return, you can immediately expense these. You don't have to amortize them over 5 years. So 2 different business provisions that are out there. Does not really impact 2024, but is in the pipeline for 2025 if for whatever reason we don't get any extension to the Tax Cuts and Jobs Act.
If the bonus depreciation for federal goes back to 100%, Nebraska will go back to 100% too, correct?
Correct, you're right. So this is more of a backstop. So if something good happens on the federal side, we're back to 100%. You're not going to be limited to 60% for Nebraska. You will be back up to that 100% for Nebraska as well. This is more of a just in case provision. There's a new tax credit if you're trying to bring employees from outside of Nebraska to work physically in Nebraska. There's this tax credit for 50% of moving expenses up to $5 grand. If you're a Nebraska business moving an individual into Nebraska to be a Nebraska resident, and they have a salary between $70,000 to $250,000. So it's an incentive for corporations to bring in higher salaried employees into Nebraska. If they're here physically, that business can get a credit for some of the moving expenses to move them into Nebraska. On the flip side, that employee can also get a benefit for they can make a one-time election to completely exclude their Nebraska source wages from Nebraska taxation for one of their years in their first 2 years of moving to Nebraska. So the employee can get a pretty nice benefit for coming here. They won't be subject to Nebraska tax on their Nebraska wage income for one of those years, which would be pretty nice. There's also been a change to the convenience of the employer rule, basically when you have to do withholding for out-of-state remote employees. So starting in 2025, non-resident employees must spend at least 7 days working in Nebraska before their income is subject to state withholding. So keep that in mind too. Different change in 2025 about how sourcing of wages is going to work with remote employees. So there's also this new child care tax credit for Nebraska, and this is still somewhat in flux. I would say wait around till we find out some more information about how this actually works. However, the portal opens up on January 2nd of 2025. And if you're trying to qualify for this credit, you need to send in an application ahead of time. And if you don't get your application in, there's a chance you won't have any credit allocated to you because it comes on a first come, first served basis. So if you think you might qualify, you probably want to send in one of your applications, but we don't even know what the application looks like yet because we can't even see the portal. But here are the highlights that we wanted to give you in case you think this might be relevant for you. And this isn't an income tax credit per se. It's a whole separate credit. There's a whole separate process you have to go through. So this isn't something you'd really see on your Nebraska 1040N like you would with the federal child tax credit. It's a whole different process. Again, still in flux. We're still trying to figure out how this will actually work mechanically, but we don't have all the details yet. At a high level, you can basically get $2,000 per child, and MAGI stands for modified adjusted gross income. So it's going to start with your federal adjusted gross income, but then there's going to be some other add backs to that to increase it slightly. So household income, $75,000, or if it could be $1,000 credit if your modified adjusted gross income is between that $75,000 and $150,000. If you're over $150,000, you're probably not going to get anything. So that's your first hurdle. Your second hurdle is you need to meet one of these other three requirements. And it's basically being in childcare, an exempt childcare organization, or your household income is less than 100% of the federal poverty line. So keep that in mind. If that's something you think you might qualify for or know someone who could qualify for, portal opens up January 2nd. Probably want to send in an application to save your spot in line to try and get one of these credits. The process does work a little bit differently though. It's a separate application. You get a separate check, not really related to your income tax return. More to come on that, but we wanted to bring it up because the deadline is coming up pretty quick here. Then planning opportunities at the very end, just some high level things we wanted to run through and just keep in the back of your brain just in case. So we have our HSA contributions boosted up to $4,150 for self-only coverage, $8,300 for a family. Your charitable donations, we mentioned, think about going to a community foundation and setting up a donor advised fund to do that bunching so that you can take advantage of having a higher amount for an itemized deduction in 1 year, because it's pretty hard to hit that threshold right now with our current standard deductions. Otherwise, if you have an IRA, instead of your IMD, taking that qualified charitable deduction, because that doesn't have that 60% AGI threshold at all, doesn't even hit your income tax return per se. You have to disclose it, but it doesn't impact the rest of your return. And for your state savings, you can do the Nebraska Nest or 529 plans and get deductions of $10,000 or $5,000 married filing separately on your Nebraska return for donations to these plans or contributions to these plans. Retirement contributions, your different thresholds for this year, $7,000, $1,000 for your traditional and Roth catch-ups, 401k, $23,000, $7,500 catch-up, then your different other plans that are down there as well. Fixed assets, we touched on this, bonus depreciation 2024, 60%. 2022 is a final year for 100% bonus depreciation, and then we're phasing down over the next number of years unless something can change there. Nebraska would keep that 60% unless there is a change. 179 limit, mentioned alternative to doing the bonus depreciation or getting that 100% expensing, but you are subject to do different thresholds. There's a total limitation of 1.2 million. Then there's an actual purchase limit of about 3 million. If you're trying to buy new vehicles, keep in mind that if it's a fairly expensive new car, that there are limitations on how much bonus depreciation you can keep in the first year. But if you're buying an SUV or a heavier pickup truck, not quite the same limitations there for bonus depreciation, but you can run into some 179 expense limitations with those. Real property, we mentioned a couple of different deductions that are out there. Still makes sense to do some of these cost segregation studies where you break out the different pieces of property in a larger building. So hopefully you can get faster depreciation on certain lives. Makes a little bit more sense now that we can't quite get the 100% bonus depreciation, and lives of our depreciable assets are going to matter a little bit more. We want to break those out, try and get the most quick depreciation we can. 45L studies for different houses for home builders, the 179D deduction, and 1031 exchanges still in effect. You can still do that property swaps to get different properties. I haven't even really heard of anything negative about 1031 exchanges lately. Still a pretty good option. One other thing I wanted to mention at the end here is just real estate professionals. We get this question a lot. How do I become a real estate professional? I have some real estate rental property. I don't like that my losses are passive losses and I can't use them to offset my other income. So how do I actually become a real estate professional so I can use some of these losses? Well, I have to spend 750 years in that real estate activity, and it needs to be more than half my time compared to other activities. I can aggregate together all my rental activities into one activity, as opposed to looking at 750 hours on a rental by rental basis. So keep that in mind. If I need to establish material participation, you can group some of your activities together. The key thing to watch out here, though, is this whole self-rental trap. If I'm renting property to myself, I'm going to have the income be treated as non-passive or active income, but then any losses as passive. So I don't quite get the same bang for my buck as I might have been expecting. And if I am trying to do real estate, keep in mind if I'm trying to claim that 20% QBI deduction or not, the 20% really only applies to business activities as opposed to non-business activities, rental activities, somewhat in the middle. So make sure you're doing enough business-like activities where you can claim that 20% deduction. I think we're going to turn it over now to questions. I know we had a few things pop up in the chat. You might not be able to see it, but we'll see if there's anything else going on that we want to talk about. So a couple of questions. I think, Leslie, if you want to start with the first one, if you want to read it out.
The first question is, do the 25C and 25D require the residence to be my primary home? Does a second home qualify? And within the slides, I believe it was that chart that compared the two credits. It shows that it does have to be your primary residence, which is where you live a majority of the time. So a second home would not qualify. Also, for residents or rental houses, they won't qualify for either of these credits, but they would qualify if they're a business for the investment tax credit, since that is a business tax credit.
And it looks like we had another question about if there's any senators that are still trying to work on passing effects for this upcoming January that would be retroactive for some of these tax provisions. So my comment to that is it looks very unlikely. I know there's a few members of the House that are still pushing to get a retroactive fix, particularly for the research and experimental expenditures to be retroactive back, but I'm not seeing a whole lot of good movement on the Senate side. There's a few other groups I work with that do more specialty tax provisions, specialty tax credits. They talk to senators quite frequently, and it looked like a lot of the senators that we were hoping and were initially trying to get this fixed retroactively have more or less abandoned the cause and are now just focusing more on some of these other non-tax priorities, or if they're thinking about tax legislation, it's all very much focused on the Tax Cuts and Jobs Act prospectively. Unfortunately, from everything I'm hearing and seeing on Capitol Hill, I don't think you're going to see any type of retroactive fix for any provision, even though we've been told for years, yes, we're going to get a retroactive fix to research and experimental deductions. Yes, you'll be able to immediately expense it. It just doesn't look like it's the same priority that it was, or that it's even economically going to make some sense, because the Tax Cuts and Jobs Act, to get all those back in place, it's going to be expensive. There are certain things they're going to have to cut just by how that budget reconciliation process works.
I think that's all of the questions, unless anyone has a last minute question they want to add to the chats.
And if not, thank you for being here with us today. Like we said, we'll send out the slides and I think even a recording of the presentation to everyone who is here. We appreciate your time and hopefully you found this helpful and good luck with the rest of your year.